The Hedgeless Horseman here, April 15, 2022. In this video, I'll discuss a bit about how I look at exploration. I've discussed this a few times before, but I was reminded of how important it is to have a process and a strategy, etc., because I found myself recently, let's say, lured to make some of the, in my opinion, mistakes I used to do and the mistakes I see people do all over again all the time. And that's just simply being a bit too greedy, being a bit too impatient, you wanting returns as fast as possible, no matter, let's say, the risk level, and how you really need to think about things to have a strategy that will should allow you to outperform over the longer term. And you have to fight your impulse for immediate returns, immediate great returns, and think about it less from a human nature feeling perspective and more from a zoomed out common sense rational perspective, so you actually have a strategy and process that makes sense. I got reminded of this topic very recently when I decided to join a private placement with BCM Resources. If you watched the Crescat presentations, you know that Crescat is involved, and Quinton has talked about this company recently. It has one of the best porphyry exploration teams around. They're drilling a very big anomaly in Utah and hope to find a major new porphyry discovery. And again, I think he's the CEO, Sergey. He was interviewed recently by Quinton. He has a very very impressive resume. So you really have some of the best people in the world involved looking for a porphyry here, so it sure is a legit target, because these people wouldn't I don't think they would care if it wasn't a legit target. I don't think it's money that drives the serially successful people in exploration, let's say. So anyway, this is kind of a high or kinda a very high risk, high reward play. So they're drilling deep, kind of expensive holes, and they did a raise in order to be able to drill even more, because they are seeing, visually they're seeing copper mineralization, etc., over hundreds of meters. Question is always what the actual results are, etc. And since porphyry bodies aren't that can be very tricky, there's no guarantees that there might be a giant system here, but it might also be uneconomic, or it might take time to find the actual high grade core. So it's like Sergey said in his interview with Quinton, it really is a process. So that's also what makes it a bit tricky, that it can take X amount of holes. Sergey talks about Ivanhoe drilling Oyotogo, and that I think they made like the barn burner discovery, whatever, after I don't know 127 holes or something like that, which kind of shows how much. I mean, today Oyotogo is one of the largest, most valuable deposits in the world, so it was really worth it in the end. But it shows just how much money can be spent before you actually find that bullseye, let's say. Anyway, so it's a very exciting story, and you look at the chart. I mean, this looks, it's obviously coiled. You have higher highs, higher lows, basically, well, or at least flat highs and higher lows. So it's contracting, and it appears that I mean, if it breaks this level, let's say, it should fly. But that could happen before news releases because of drill hype speculation, which I wouldn't be surprised to see. And I've talked about this before, that one very low risk way to play, or quite low risk way to play some stories, is to let's say bank on some pre-assay drill hype returns. I mean, this stock might head to, who knows, maybe it heads to, 70 cents before actual assay results. So before the rubber even hits the or meets the road, you could be looking at a double from here. And again, it's like the prospect of finding or making a big discovery, the allure of a 10, 20. I mean, if this ends up being a true blue sky case scenario where they actually have a giant copper porphyry in Utah, I mean, that could be worth billions. And if you look at the market cap now, this is pre this current financing, but obviously there's a lot of room to run. So there's theoretically, a 10, 20, 30 bagger ahead. I mean, that is a possibility, and that's what keeps us engaged, obviously. That's what, okay, man, if I get a 10, 20 bagger, I mean, that would be great. So it's like, in theory, oh, I'm going to make this bet, and then I could have, yeah, could have, a 2,000% return, etc. So that's obviously where the greed factor comes in. It's you want that winning lottery ticket because that's quote gonna change everything. So I thought about this, like, okay, how much should I participate with? Because okay, big target, you start to think, you start to discount the future, start to pick out the colors of your Lambo, etc. But at the end of the day, it's like there are certainly no guarantees. I don't know what the actual probability of finding a bullseye hole in these current, drill holes they're drilling. But it certainly isn't what I would guess isn't 50-50. If it would be actually, I mean, nobody knows the actual probabilities, but if it would be 50-50, that would be an absolute no-brainer. But again, there might be a big price here, but that might take a lot of time to actually find, and they might need to raise more, etc. So there's a million different scenarios, let's say, going forward. And how do you make a strategy out of that? That's, I mean, in my opinion, to limit the uncertainty and risk as much as possible. So my impulse for a minute or two was to, maybe I should actually try to get even more of this financing. I think now it's too late anyway. But that I got greedy, thinking, oh, hey, maybe, looking at the target, like, what could this mean? Oh, if they hit really big, that's, massive. But at the same time, I stopped myself, like, thought about, wait, I mean, this is what I've been talking about, trying to limit uncertainty and risk as much as possible and put the odds in my favor to have a long-term outperforming strategy. So then it's like, okay, yeah, I'm gonna go back to the basics of why I typically go big in post-discovery plays and don't really play around this that much with pre-discovery plays anymore. So I just did this isn't really finished, but I thought it still, since it was fresh in my mind, I thought I would do a video on this. So it's like, here we have, let's say we have $10,000 to invest, and we make some assumptions of a discovery play, or let's say we have identical discovery plays, let's say 10 different stocks. So let's say there's a 10% chance of a significant discovery being made, and the stock goes from 20 cents to $4 within 3 years in case of a success. So 10% of the cases, the stock will go from make a discovery, go from 20 cents to $4 in 3 years. That's also an important thing, obviously, that people want multi-baggers, including 10 baggers, but they watch a stock price every day, which again makes no sense because typically you have to wait for years. So that's a fallacy I've talked about before, that we talk about superb returns, but nobody really has the patience to actually get them, which is kind of interesting. And the day after the discovery hole, the stock immediately opens up 150% higher to 50 cents a share. This is also one fallacy that, and I typically did this myself, that when I see a discovery being made, and you see 100% or maybe even more, but let's say 50 to 200% update after discovery, and you think, the impulse is to think that I missed the boat. Because I mean, if you look in the forums, there's a bunch of people like, yes, hell yes, I was in heavy, etc. And you're sitting there like, being a bit jealous of them, and don't. I mean, I think one impulse is actually, well, if I bid this stock up, I'm gonna make that guy I'm jealous at even more happy, because he's gonna sit at even better returns while I'm getting in with neutral returns. So that's also a very human fallacy, let's say, that some other person's returns has anything to do with your future returns. No, that's just being petty, basically. And in case of no discovery, the stock trades down 50% to 10 cents a share. I mean, some might trade down more, some might trade down less, depends on the company, etc. But in order to have a simplified scenario, let's stick with that. So we have speculator 1 here, pre-discovery risk fiend, as I call it. He places $1,000 in 10 different pre-discovery plays. Since the chance of success is 10%, we're just assuming that one case will actually be successful and make a discovery. And that's also, I think that might be oversimplification, or let's say too ambitious in terms of the odds. Typically, there's not 1 in 10 juniors out there making a significant discovery. So that's actually, I'm actually very, let's say, I'm overestimating the chance of success. But the point still stands. So it would be even more extreme if I actually used a more, number that's probably closer to reality. But anyway, so he has a portfolio of 10 stocks, 10 pre-discovery plays. 9 of them will miss, and he will lose $500 on each. And things can happen in the future. Maybe they drill again, or have another project, etc. That so we're not thinking too much of the different future scenarios. We're talking about a hot money guy who's like, he's gonna leave if they miss, etc. But he has the patience that in the 10th stock that actually makes a discovery, he will sit on it for 3 years. The stock will reach $4, and he'll have a 1900%, a 20 bagger. So total portfolio worth goes from $10,000 invested to $24,500, and he has 145 return over a 3-year period. Obviously superb results. 145% over 3 years is great, even though that's what people expect to happen within 3 months at the latest. So think about this. It's like, I think I'm overestimating the chance of success at 10%. I also think that these people, or the people that have this kind of risk profile, do not even have the patience that the one stock that actually makes a discovery, I don't think they would be able to sit on their hands for 3 years. So think about it. I don't think this actually, from the get-go, this is probably a too optimistic scenario. And I don't think most people would even have the patience to play it out. So the 145% is like the blue sky scenario in this case. That's something to think about. Then we have the speculator 2, the post-discovery hunter. He also places $1,000 in 10 different, but post-discovery plays. They've already made a discovery hole. getting into newfound gold after the 19 meter of or 17 meter of 92 grams per ton intercept, or Eloro Resources after the discovery hole at Santa Barbara, or let's say SK Mining after some major holes into TV, etc. So he's getting in. He has a portfolio of 10 different stocks. Every stock he gets into after it appears that they made a discovery hole. No guarantees of the future, but a lot better odds because there's something there. And we just, in this case, I mean, again, this is probably or could be too optimistic, but in some cases it might not be too optimistic. I mean, some stocks, one discovery might go to $8, one might go to $2. I mean, it depends. Some will end up losing, but we're having an average here just to make it simple. So this person has no problem paying 150% higher than what a risk fiend would pay, who got in at 20 cents. So he's buying after the discovery, and the stock is up 150%. He doesn't care about what gains already current owners has on him. He's trying to limit risk. He's buying after it's been de-risked. He's okay with having a lower return in exchange for a much lower risk. So he gets 700% instead of 1900%. But his chance of success and return per average case is obviously very different than this person. And as in this scenario, this investor makes it out with 700% after 3 years. And if you have this kind of strategy, I think there's also a higher likelihood that you're not too impatient and you can actually sit it out for 3 years to get 700%. Obviously, way higher returns than this person, which I also have a less chance of having the patience required to even reach this. So some comments here, and the portfolio goes from $10,000 to $80,000. Only 2 out of the 10 stocks would actually need to deliver said 700% return in order to not just lose money, to at least be neutral, actually a bit better. The stocks could open up 300% higher post-discovery before this speculator buys in, and the return would be 400%. Still over double this, even if this person paid up 300% higher. So it 4-bagged the day after the discovery when this person bought in. That's not easy to do, to pay up that much more than the people already celebrating. The ending price here, another scenario, the ending price could be lower to $3 and the portfolio would still return $500%. So the end price in 3 years could be lower to $3, and this would be still massively outperform this person and would be extreme returns. Then we also come into the, I haven't expanded this in full, but just to show, I've talked about getting into private placements, have the warrants, etc. Because in BCM mining, for example, I'm getting 1-year warrants as well. So that basically tipped the scale for me. Obviously, not everyone can get into every deal, and I think it's well oversubscribed, etc. So that's a perk. Obviously, that's just how it is. For the longest time, I didn't participate in one private placement in the first 4 years, I think, and I still beat the market handedly. So it's not like it's required, but it does give you more tools. Let's say you can change your strategy a bit, because let's say this same speculator here, but he went into private placements at 20 cents and got warrant with some strike price. So in the cases they miss, he loses as much as this person, because obviously warrants doesn't add to the downside, but it adds to the theoretical upside. So in this 10th stock that actually hit, he gets a 2,900%, a 30 bagger instead of a 20 bagger. So just from having warrants and having the same success rate, let's say, this person with warrants gets a 245% return. Now, one caveat is that this scenario assumed a 3-year holding period, and there's not too many 3-year warrants out there. So, I mean, this might not be exactly according to reality. In the case of BCM, for example, I think the warrants have a 1-year period. So you would need this run to happen within 1 year. That also points out how important or how good it is to have a, I mean, I remember Rick Rule, I think, and Marin Katusa talking about, the good old days of getting, a 5-year warrant. Because warrants obviously puts a time limit on upside, so you want drastic price changes, and you need them within the time frame of before the warrants actually run out. But anyway, it's like 100% extra return within 3 years just from having warrants. That's, massive gains, obviously. So try to get into private placements if you like a stock, and also consider, I'm much more inclined to invest early in high risk stories if I have warrants. That should make sense, Then you also have to consider things like adjust for valuation environment. I mean, if you can buy a already proved discovery, etc., or a similar discovery at 50 million, let's say $50 million market cap, and you're getting into a 30 million pre-discovery junior, which that stock's blue sky is similar to something that's already in this depressed environment trading for 50 million. I mean, even if theoretically that's a good bet because they are simply both are undervalued, you'd probably be better off just sticking with the post discovery play at $50 million, even though it's boring because or according to the market. So that's relative risk reward, again, compared to other companies. And of course the drill hype thing, this isn't this doesn't work all the time, but you also have that you could play that kind of scenario that you take money off the table before assays to limit assay risks. And again, like I talked about, warrants favor drastic price increases due to time limit, etc. And you need to reach that threshold where the warrants actually kick in. Every case is unique, you can't forget that. I mean, every target has a different risk profile. I mean, Goliath, for example, I thought it was one of the least riskiest pre-discovery plays or pre-drill hole confirmed plays, because they had outcropping mineralization all over the place, showed good grades and widths, and wouldn't they hit on every hole. So this was one where I was much more comfortable actually going into assay results, for example, and that's why I have fairly large position right now in Goliath, because yes, the blue sky is not proven, etc., but based on what we know of the system and that 1 kilometer step out hole, it looks to be abnormally predictable. So I wouldn't have that kind of position I have now in perhaps any other type of drill play with the same, at the same stage as Goliath. Because most systems doesn't appear to be that predictable, that large, etc. But there's still risk. It's just that, in my opinion, the geological risk appears to be way less. So, takeaways. I think you should be this person, especially if you don't, if you're not able to get warrants. The math makes sense, makes a lot more sense. Results would be superior, but this is where most people constantly are. This is the strategy employed by most junior mining speculators. So again, I had to remind myself of this with BCM because I got very tempted to go kinda big. But then it's like when I think about it, okay, if they make, if there is something, if there is a really big deposit there, I could probably afford to buy in more post discovery, even if I paid up. Let's say it went to at least 100%. And post the current dilution, let's say it goes to 60 million. If there is a large porphyry discovery here, if they make a discovery hole, even if you pay up 100% more, $60 million you're buying the company at, that has a lot of room to run over the coming years. Because if they are finding a deposit that could be worth billions, maybe blue sky is 2 billion, it goes up to 60 million, and let's say you think there's a 50% chance that the 2 billion will materialize. That's still 1 billion in implied value today versus 60 million you're paying up. So, and you can discount that a lot more. If you think there's a 25% chance of reaching a value of 2 billion after a discovery hole, that's still 500 million. That's almost a 10 bagger. And you could discount that by quite a bit, and it still would be a favorable bet. You wouldn't be overpaying for it, but it still would be kind of high risk. But again, if you diversify in this environment, you could put 20 stocks here, buy them post discovery, and it would even out even more, obviously. So again, I think this is the superior way for most people to play this junior sector. And that's how my strategy has evolved to, basically. I'm way less inclined nowadays to take a big position in any pre-discovery place. Because I understand, and I've seen this 100 times before, you can buy most future 10 baggers for, let's say, 100-200% more the day after the discovery, and you'll still get a 10 bagger. You've seen that with Great Bear. If you bought after the discovery hole, even if it was up 100-150, you still got like a 20 bagger within 4 years. So even, yes, the person that bought or was in with a big position pre-discovery, they will probably blow your returns away. But they will also get cut down at their knees in most stocks they do the same thing with. So that's one thing to always keep in mind, that the person who is, let's say, quote, lucky being in big in a pre-discovery play, he might blow himself up in the future, or he might be down a lot in a lot of other stocks. Because people don't tend to talk about the negatives of their portfolio or how their portfolio has actually performed. They highlight the ones that do well, etc., of course, because they gain some, internet fame, feel good about themselves, have people say, "Oh, you're so lucky," etc. But most people don't actually beat a market, and most people don't brag about their portfolio returns because they have these one-offs, etc. And even if they would have superior returns, not a lot of people would could stomach sitting out in Great Bear if you were in heavy early on and then it goes up. I mean, they wouldn't sit for 4 years, I think, to actually get a 40 bagger or whatever. So you have to think about the context of everything and understand how people work, and understand how, let's say, need for validation and pride and stuff works, and what you only see what people write in the forums, etc. That's just one they're showing one side typically. Like I don't have anywhere close to 100% success rate, but you don't need it. So again, it's like there's a reason for Eloro, for example, being one of my largest positions. How do you, in my opinion, how do you beat this risk reward? It's like, the CEO recently bought uh, more shares. So you have insider buying at a time where I think Eloro is way undervalued. Post discovery, where they already know that they have a lot of mineralization there, and they recently put out some barn burner holes into this big thing, which would suggest that there's going to be a lot more of these drill holes coming, because this is already de-risked by quite a bit. So how do you beat this kind of risk reward? CEO buying early into the second big discovery, already drilled up a bunch of stuff to the northwest, Santa Barbara, which this stock might be undervalued based on alone. And you have this kind of pattern here. You have a box here, box here, box here. Very good runs every time the box breaks. So if you ask yourself, like if you just consider what we know, CEO buying appears to be a massive system, made a second discovery with some barn burner holes. Which way do you think this box is likely to break? If it's up, this kind of consolidation suggests it would be a massive run. If it's down, probably a massive decline. But based on what we know, and such as the CEO recently buying more, which, if you had to guess, what's the likelihood of this breaking up? In my opinion, it's at least 70%, at least. I might be wrong, and nobody knows for sure. My guess is at least 70%. And when it breaks, it should be a big run higher. I don't see many cases, risk reward cases like this. This is again, in my opinion, like a 70% chance this will have a good run. In BCM's case, I can say there's a 70% chance that they'll make a bullseye hit. But even if they hit, that's probably just going to open up 100, 200% higher after the discovery. And then there's perhaps a 70% chance after that it will deliver a multi-bagger. That's good risk reward in my book. I thought I had some more examples, but you get my, catch my drift. It's like SK, post-discovery play, bunch of targets, so it's both a pre-discovery play and a post-discovery play, but they have so many targets that it's likely that they will hit on some more, and it's likely that TV and Jeff will grow. So these are, in my opinion, in this category. Post-discovery plays, I expect to be able to just sit on my ass in many of these cases, not this one, but stocks like Eloro, and I think they'll simply go higher. And that's why I think I expect to greatly outperform the index for years to come, because I feel like I'm getting better and better and better at limiting risk and putting the odds in my favor, etc. Whereas most people will hang out in this category here and complain about the mining sector and you can't make money in miners, etc., because they never self-reflect. They don't think too much about their actual strategy. They think everything is based on luck and bad luck, and that there's no way to actually beat the market. I think that's, I see so many, in my opinion, human errors, because I, did them myself. And like everything, I mean, in poker, etc., it's just a small percentage of players that actually beat the game, because they self-reflect. They try to figure out their own weaknesses. What mistakes are other people doing? How can they take advantage of that? And then they, with time, if they study enough and self-reflect enough, they come up with a strategy that, okay, this has the best chance to actually have consistently good returns, and trying to limit risk as much as possible relative to the upside scenarios. So if I hope some of these concepts make sense, because they make total sense to me, and so far they have been uh, working very well. So you have to, again, it's like you have to hammer in these human fallacies of like impatience, uh, the need to have immediately great returns, and that is typical for almost everyone. So you have to fight that and realize there are superior ways to play the market, and you will have to forget the fact that yes, if you buy in after discovery, some could theoretically have much better returns than you if they hold as long as you, but you have to forgo that, let's say, jealousy uh, thing, and like that doesn't affect you, and you have no idea how their portfolio is doing otherwise. You have to force yourself to make the most sensible thing at any point in time, regardless of what anyone else is doing. And to circle back to BCM, I got a starter position. The greed and impatience in me, let's say, wanted to take an even larger position. Then I reminded myself about the fact that you can have very good returns and at way less risk if you buy in after the fact, even if you have to pay up 150%, let's say, and simply have this on the watch list. If they do make a discovery, the case will change, or if they have a discovery hole, the case will change overnight, and then I might, who knows, plow in with 300% more funds. But of course, there will be people that already plowed that in, and they'll massively outperform me, let's say, in this particular stock. Will they outperform my entire portfolio over the long term? I don't think so. But you have to have that kind of discipline, and yeah, do yourself a favor. It's not. Again, this is not really helping me, of course, in the sense that if everybody did what I did, I would pay up even more after a discovery. But I'm trying to, as much as I can, to actually help people beat this market. And therefore, I'm not saying, bump up BCM right now because I just took a starter position. That's not obviously what I'm saying. It's kind of the opposite, actually. Unless you think you can play the drill hype part, for example, but that's no guarantee. If it doesn't go up on drill hype, you're stuck with the you're stuck with, and it goes down, you're stuck with the risk. So either you have to sell if you're not comfortable with going into assay results at a loss, and then maybe they make a discovery and the price has gone down, so you actually have a better risk reward profile, although it's very high risk. So again, this is not science. Investing is not science. It's an art, and you have to. The main thing is that you have to know what you're doing. Play forward the scenarios. Do what based on the different scenarios that can happen. Do what makes most sense for you personally, and what makes most rational sense in a vacuum, obviously. And don't try to get rich overnight. That's the main thing. if you can just average 30% returns per year, you would absolutely you would get rich in time. Whereas most people look for long shots to get rich tomorrow, and 99% of them will never get rich because one of these days they're gonna blow their whole portfolio up. Uh, Thanks for listening. I hope you got something out of this, and uh, maybe bookmark the video, etc. When you find yourself getting greedy with a discovery play or holding off, let's say buying a post discovery play. It's like remind yourselves of this concept. I have to remind myself of this concept. Uh, that's again that's what a strategy looks like. That's what common sense, trying to have the best soundest strategy, uh, looks like. Have a plan for the longer term. Yeah, thanks for listening. Bye. Oh, and of course, consider me biased. I now own shares of BCM. I own shares of Eloro, SK, and probably every other stock I mentioned, and Newfound Gold. Yeah, SK, Goliath. Most of them are sponsors except BCM. Thanks for listening.